Would you like to know how you can tell if an advisor specializes in individual income-producing instruments versus an advisor who uses a combination of stock market and growth-oriented vehicles? Because if they specialize in the latter, they're more likely to invest your retirement accounts into bond mutual funds rather than individual bonds and bond-like instruments. Why is this important? Because when an investor buys an individual bond, they have two important guarantees. First, they're guaranteed a fixed rate of interest for the life of the bond, and when the bond matures, they're guaranteed their principal back, assuming there has been no defaults. With that assumption, an investor knows exactly what they're going to earn on the bond that they hold to maturity. So how then do bond mutual funds compare to individual bonds? Bond mutual funds don't pay a fixed rate of interest. As a matter of fact, the interest that they pay fluctuates. Also, bond mutual funds don't have a maturity date. They will go on forever or until you liquidate them. So both guarantees that are inherent in individual bonds are off the table, so to speak, with bond mutual funds. So why does this matter in the real world? Most investors know about the inverse relationship between interest rates and bond values. When interest rates go down, bond values tend to go up. And when interest rates go up, bond values tend to go down. If something happens in the bond market to cause bond values to drop, a portfolio of individual bonds as well as bond mutual funds might drop the same in value. However, if you're holding individual bonds, the loss is simply a paper loss because you're still going to receive your fixed interest payment, and when the bond matures, you're still going to get your principal back. But if you're holding bond mutual funds, then it's not a paper loss, it's a true loss. Because remember, those bond mutual funds never mature. That's one reason bond mutual funds can be a lot riskier than individual bonds. In addition, bond mutual funds have management fees associated with them, which effectively lower the yields. These fees do not exist with individual bonds. Why then do financial advisors still utilize bond mutual funds instead of individual bonds? It may be because most financial advisors today still specialize in growth-oriented, stock market-based strategies. And since the analysis of stocks and stock mutual funds is much different from the analysis of individual fixed income investments, advisors typically won't specialize in both. So fixed income becomes merely an afterthought. So in a way, you can think of bond mutual funds as a simpler way for stock market-based advisors because they're leaning on a fund manager to pick the individual bonds for them. But like most things in life, simplicity comes at a cost. This isn't to say that there isn't a time and place for investing in bond mutual funds. For instance, if you were an investor just starting out and you didn't have enough capital to properly diversify in a portfolio of individual bonds, then at least bond mutual funds give you a way to leverage a low dollar amount to help you diversify your portfolio. However, most people in or near retirement who have saved their hard-earned money over a longer period of time are better suited to invest in a portfolio of individual fixed income securities for the purposes of safety and steady income. If you would like to learn more about whether individual fixed income securities are right for you, or if you simply have some general questions to learn about our firm, visit our website or give us a call to schedule a free consultation with one of our advisors.